Hello and welcome. Today we're going to tackle a topic that, let's be honest, sounds really complicated: stock market options. But what if I told you the whole idea is actually as simple as booking a new car? Stick around because we're going to break it all down.
So here's the big question for pretty much anyone who invests. How can you get in on a stock's potential success? That big win, without facing a total disaster if your bet goes wrong. Well, that exact problem is why options even exist.
Okay, before we even whisper the words stock market, let's start with a simple story, a situation I think we can all wrap our heads around. Let's just imagine for a second that you're out shopping for a brand new car. All right, so picture this. You find the perfect car. It's 5 lakh rupees. But you're in a bit of a jam. You've heard a tax hike is coming next month, which is definitely going to push the price up. And to top it all off, the exact color you want? Well, it's not in stock. It won't arrive until next month. So what do? Just then, the showroom manager comes over with a pretty interesting deal. He says, look, pay a small, non-refundable fee, say 10,000 rupees, right now, and if you do that, we'll guarantee you can buy the car next month at today's price, no matter what happens with that tax hike. So, a month goes by, and now one of two things could happen. Scenario 1, the tax hike is real. The car is now way more expensive. Your decision to pay that booking fee? Absolutely brilliant. You get your car at the old, cheaper price. But what if, in a surprise twist, there's a tax cut instead? Now the car is actually cheaper. And here it is. This is the absolute key to everything. If the car gets cheaper, you're not forced to buy it at the higher price. You just walk away from the booking. Sure, you lose that 10,000 rupee fee, but now you're free to buy the car at its new, lower price. Your maximum loss was capped at that small fee. You had the option to buy, but not the obligation. Okay, now that you've got this car story in your head, let's see how this exact same logic, this same idea, connects directly to the world of company shares. This is where it all clicks. That small, non-refundable booking fee from our story? In the stock market, we call that the premium. The locked-in car price of 5 lakh? That's what we call the strike price. And that powerful right to choose to either buy or walk away, well, that, my friends, is the option itself. See? Simple. So let's apply this to a real-world kind of situation. Imagine there's a TV company and its stock is currently trading at 100 rupees a share. Now, this company is about to place a huge bid for the broadcast rates to the IPL cricket tournament. This is a big deal. Now, you as an investor are looking at this and thinking, wow, if they win this bid, the stock could double to 200 rupees. But if they lose, the disappointment could send the stock crashing all the way down to 50. Just buying the stock feels like a massive, massive gamble. So instead of just buying the share and hoping for the best, you buy an option. You pay a 20 rupee premium. That's our booking fee. And what does that get you? It gets you the right, but remember, not the obligation, to buy a share for 100 rupees, our strike price, anytime in the next month, right after the bid results are out. Okay, so let's play this out. Let's look at what happens to our savvy investor in both of these possible outcomes. All right, first up, the bad news. The company loses the bid, the stock tanks, falling all the way to 50 rupees. Now, if you had bought the share directly, you would have just lost 50 rupees. Simple as that. But with the option, why on earth would you use your right to buy a share for 100 when it's selling for 50 everywhere else? You wouldn't. You just let the option expire. And your total loss? Just the 20 rupee premium you paid. You've limited your risk in a huge way. Okay, now for the good news. The company wins the bid, and the stock skyrockets to 200 rupees. You immediately exercise your option, buying the share for that agreed-upon price of 100. Your total cost is that 100 rupee strike price, plus the 20 rupee premium you paid up front, so 120 in total. That means you made a profit of 80 rupees a share. Now sure, it's a little less than the 100 you would have made buying the stock directly, but that 20 rupee difference, that was the price of your safety net. That was your insurance. So let's just make it official. What is an option? It's a contract that gives you the right, but, and I'm going to say it again, not the obligation, to buy or sell a stock at a price you've already agreed on by a certain date. That freedom of choice is what makes it completely different from something like a futures contract, where you have to follow through. With an option, you are always in the driver's seat. Now that we've really nailed down the main idea, just know there are two basic flavors of options. Which one you'd use just depends on which way you think the stock is going to go, up or down. So everything we've talked about today, that was a call option. It gives you the right to buy a stock. You use a call when you're feeling bullish, when you think the price is going to go up. The exact opposite of that is a put option. This gives you the right to sell a stock at a set price. You'd use a put if you're feeling bearish, if you think the price is about to fall. All right, let's zoom out one last time and just really hammer home the most important takeaways from all of this. What do you really need to remember? At its heart, an option is all about one thing: choice. It gives you the right to do something, but never forces you into it, never gives you the obligation. And because of that simple, powerful feature, your maximum possible loss is always, always capped at whatever premium you paid at the beginning. They're an incredibly powerful tool for managing your risk. And there you have it. We went from a simple story about buying a car all the way to the core of how a financial option works. We've peeled back all that complexity to find a really powerful but pretty simple concept for managing risk. But the journey doesn't stop here. You now know what an option is. The bigger, more exciting question is, what are you going to do with that knowledge?